Again, I want to introduce you to price charts. There's two major types, and we'll go into these in a lot more detail in further lectures, but it's just introductory for the moment. Open, high, low, close, and you can see what this means. Each one of these bars is the high the price has been for that period. It might be a 1 minute chart or a 1 hour chart or a 1 day chart. If it's a 1 day chart, then this represents the movements in a whole day. If it's a minute, it represents the movements in a minute. The highest the price has been in a minute, where it opened, where it closed, at the end of that minute and at the start of that minute, and what the low was. The range is the high minus the low. On the right-hand side, you see something called Japanese candlesticks. Similar principle, but just displayed differently. They tend to be, if the open price is higher than the closed price, in other words, if the prices move lower, they tend to be red or black. And if the closed price is higher than the open price, in other words, the price has gone up for the day, or the period under question, then it tends to be white box on the whole, okay, or blue to signify it's gone up. Red and black are bad, white and blue are good. Now, these are then the building blocks for price charts. What do these price charts look like? Well, let's look at some typical price charts and introduce some more jargon. Okay, you can see on screen there, and you don't need to see the time frames. I've purposely blurred them out because that could be a 1 minute chart. Each one of those bars represents a minute, or a 1 day chart, or even 1 year. And what you see is an uptrend, and the uptrend is worked out by drawing a line where the price just touches and kisses that line. That's then called a support line for the price. And what tends to happen is prices hit their support and bounce off, in theory. So you could trade off a support line. Again, we'll look at these strategies in far, far more detail. When the price is moving up like this, and you place a trade expecting it to continue rising, we call it going long. Going long means buying in the anticipation of price rising. When it's falling like this, and the trend line there is not called a support because it's not supporting it, it's called a resistance. And that means we're going short because we expect the price to fall. Guess which trades traders prefer? They prefer shorts to longs. Why? Because prices move faster when they're falling. That means they can profit more from falling prices if they've gone short. How do you profit from selling something in the anticipation of prices falling? How do you profit from falling prices? Well, you sell it first at a high price, then you buy it back at a lower price. Don't forget, that's still the same as buying low, selling high. It's just that you're selling first, you're selling high, and then buying low. You're doing it in reverse order. It's still the same because you're selling high, buying low, or buying low, selling high. It's the same principle. So the final chart to show is the channel or the sideways trend. And again, people anticipate prices will kiss these trends, these resistances and support levels, and bounce off them, and they often will trade accordingly and develop strategies around it. We'll look at strategies later, but the terms I wanted to introduce you to for now were trends, support, resistance, channel, and going long and going short.